Hello, Eagle investors. Today, I will be talking about trading around earnings, the do's and don'ts, as well as what to look for. If you haven't already, make sure to like and subscribe and join our Discord server, linked in the description below. We post daily options and stock alerts, as well as market commentary, and we also have education for beginners and advanced traders. Now moving on to earnings. Earnings announcements are public announcements that display a company's earnings, usually take place on a quarterly basis. It's important to understand how earnings can affect an underlying, as well as the underlying's option market. Earnings are closely watched by traders and investors as they are not only providing great insight into a company's past performance, but future guidance as well. As the earnings announcement nears, implied volatility tends to increase with people buying options to speculate on the announcement or as hedges to stock positions. This results in higher option prices and higher implied volatility. After earnings are announced, the uncertainty drops, and we usually see a quick decrease in IV. Because of this, we tend to stick with premium selling strategies when it comes to earnings trades. Long calls and puts are often too costly and can be very dangerous unless there is a large stock move in your favor. We can take advantage of the implied volatility crush by selling premium prior to the announcement and buying it back after the announcement, especially if there is very little movement in the underlying. To find the right strategies, I focus on a few things, and I'll show you in Tastyworks, the trading platform that I use now. And the first thing that I like to note is the implied volatility of an underlying stock. Now, FedEx says their earnings coming up this Thursday after the market closes, and we see that the implied volatility is at 54%. Now, more importantly, though, that's a good gauge for how volatile the underlying is, but it's better to compare that volatility to how the underlying trades relative to itself. So for that, we look at the IV rank. Now, typically, we like to target over 50, but this varies on how the market is, what the underlying is, and what strategy we want to be using. Now, next, we want to make sure we have enough open interest as well as volume. Now, a few hundred or thousand, depending on the amount of contracts you're looking to enter, is usually pretty good. The higher, the more liquid, and the easier it will be to get in and out. We also want to make note of the bid and ask spread. So for this credit put spread on FedEx, we see a somewhat wide but manageable bid ask spread. The narrower, the better, and we'll know we're getting a decent price, and we know that if we have to manage quickly, it can be done without taking too big of a hit. So we also would like to focus on a target probability of profit of around 70 to 85%. So just a more conservative strategy and helps build in a buffer as an earnings can miss or hit or move more than expected, even if you're looking at things like the expected move, earnings data, and technical levels. Now, for management, it really depends on what strategy you use. So I mentioned credit strategies. And for credit strategies, there are the undefined risk strategies, such as naked or sold straddles and strangles. And there are defined risk strategies like short iron condors, and vertical spreads, credit vertical spreads. Now with the undefined risk strategies capture more volatility crush. However, there's more risk, an undefined risk, and a far greater buying power required because of this undefined risk. So that means the defined risk strategies can actually provide a better return on investment. And we like to look at them even more. So next up, you have to note where to set your strike prices, right? So for something like a credit put spread. How do you know where to put the strike prices and whether to lean bullish or bearish or neutral? So first, we have to understand expected move, technical levels, earnings expectations, and most importantly, historic earnings data. The expected move can be found on the options chain. Here we see December 18, FedEx, the expected move is 20, plus or minus 20 points. Now we also can see the 1 standard deviation move with this line and this 2 standard deviation move with this line, or visually on the curve with these lines in the normal distribution. Next up, we have to identify key technical levels. And this can help set strategic strikes while also understanding the likelihood of these levels being reached. For example, last week we did a GameStop credit call spread over their earnings, and we sold the 19 call and bought the 20 call for potential max profit of 19%. We did this for a few reasons. One being, how do we pick those strikes? We can see here this resistance that we could have been helped by if there was an earnings beat and the stock did go up. Now that didn't happen, and why didn't we think that was going to happen? Why did we have that bearish to neutral position? We'll get into that when we look at the earnings data. So next up, we also have to take note of earnings expectations and how you can search this up in many different ways. I tend to use Bloomberg Terminal for these, as it provides a centralized data hub that has a wealth of organized information on companies and earnings events. But all of this information is public. This is just a nice way of organizing it and sorting through. So next up, we want to make note of the earnings data history. We can do this in a few places. Now, the best place, of course, would be on the Discord server. In OptionsBot, we can do something like, we can find the earnings data for GameStop. And we see that the one-day changes on these most important historic earnings data points were largely extremely negative, except for the June earnings of 2020, when it went up 2%, then proceeded to fall over 8% in the next week. And we also see here on stock earnings, 64% of the time, GameStop goes down after their earnings are released. Now, this is a trend that we can see with certain underlyings. For example, Wells Fargo, 71% of the time, their company falls. No matter if it's an earnings beat or miss or what the guidance looks like, typically has to do with all of those things, kind of leaning bearish and investors not liking what they see after earnings and exiting. Something like Morgan Stanley, however, very positive and bullish earnings data, 69% of the time goes up following. Now this, particularly Morgan Stanley and Wells Fargo, I know last earnings we did a pairs trade, which was interesting because we kind of eliminated a lot of the sector and industry risk, as well as all of the systematic market risk by going long Morgan Stanley and short Wells Fargo. I believe both of those sides of the pairs trade were profitable, even though one of them was just meant to hedge out much of the risk. So we can also see that in the terminal, we see that even if there's an earnings beat, it doesn't mean that the stock price goes up the following day. So this really goes into the idea that some companies, no matter if the earnings beats or doesn't, you've seen this with a lot of tech stocks recently, sometimes they beat the estimated EPS and yet the stock price goes down. And this is because the sentiment and the street's expectations might not have been what the estimated earnings per share was. And people thought that with this growth, with tremendous numbers and revenue and user base growth in some of these tech companies, that they continue to expect more than what was stated to be expected. So now, putting all of these resources together and curating it towards your own trading style and risk appetite will set you up for successful trading around earnings. Trading around earnings isn't for everyone, with a high amount of uncertainty, but opportunity does arise. And we research, post, and discuss all major earnings each week at Eagle. Let me know in the comments section below if you are watching any earnings or what earnings you have traded in the past. I hope you found this video helpful. Check out Eagle Investors in the link below, and don't forget to like and subscribe if you liked this content. Bye.